Hi, folks. Dan Bird here on Tuesday evening, June 3rd. And this is the after the market update and technical Tuesdays. So today I'm going to talk about using technicals for covered calls. I'll explain what covered calls are for those that don't know. And hopefully it'll help you understand it. But more importantly, how do you use the charts in order to help you to do covered calls? So that's what we'll talk about tonight. As always, I am not a financial advisor, and this is all for educational purposes only. The past performance does not guarantee future results, and you have to understand your own trading style. All right, so let's take a look first at what the market did today after my update, my midday update earlier. We'll go to the home page, and we'll notice that the market bias chart ticked up a little bit today, a little bit higher. So that's a good sign. And now let's take a look at the S&P and the NASDAQ. As I mentioned at noon today, I have included now the expected move between now and options expiration. So this gray vertical line here is options expiration on June 20th. And the green line, which is a little bit above the chart, but it's pretty much right where this high is right here. So that's the expected move to the upside, and the expected move to the downside is down here where this red line is. Notice also that I've mentioned this a number of times that we are going sideways, and I drew basically a Darvas box. I explained what Darvas boxes are in a previous Technical Tuesday back in May, so you can go back to the playlist and review that one if you want to understand Darvas a little bit better. But right now it's right at the top of that box, not quite broken out yet. But if it does, then that is a very bullish sign. And likely we are going to be heading to the top side of that expected move. Of course, we could also head to the bottom side of the expected move. And the top is 61.73. The bottom is 56.85. All right, let's take a look now at the NASDAQ. And here we have same thing, expected move right at the top, right at the highs, previous highs. This one has broken out of the box. So this is good news. I think everything looks pretty bullish right now. The expected move to the downside is down here, actually above the 200-day moving average. So right down here, there's 620. So everything is looking very, very bullish. We had really nice rally off the bottom. Had a gap up right here. That gap is still open. And then we had a little consolidation, which is healthy. And now we look like we're breaking out and maybe going higher still. So usually the first week of June usually is bullish. I'll show you that in a minute. Also, I did that for the Russell 2000. So the expected move here is right down here. So on the upside is 214, the downside is 196. But again, we are have not quite broken out of the box on this one, but we're sitting right at the top of it. And the 200-day, interestingly, is right at the expected move area. So that's where the target is for the small caps. Let's look at Bitcoin real quick. And you can see Bitcoin is sitting right on this. I drew in this potential head and shoulders. It is not actually a head and shoulders unless it breaks through this neckline down here at about 100K or so. Let's see where it is. 101. Today we went up to right below that 106 area, sitting right exactly below the 106, 105.778. And we got as low as 104.9 and as high as 106.8. So sitting right at that 106 area and right inside of this little right shoulder pocket. Now, if it breaks out and starts to move higher from there, then there is no head and shoulders. And if it goes down and does not break this line and starts going back up again, there is no head and shoulders. So I will remove these off of here. But that's what it looks like right now, sitting right at resistance. All right, let me show you what I meant by the beginning of June. So we are sitting right here. We are here. That's today. And we had a nice little rally today, right to here. According to this, we may come down tomorrow. And then we rally again into the beginning of next week. And then we get a big sell-off next week. And from here until the third week of June, you can see where it starts to climb right here. And I did this on a previous session where I showed back to 2017 every year between the third week of June until July 15th. Every single year except 2022, which was a bear market, was bullish. So that's where this starts right here, basically the last week of June. But so we've got a bullish for this week, then potentially bearish next 2 weeks. We've got a holiday in between. We've got CPI. Jobs number is this Friday. Interestingly, it starts to sell off right after the jobs number. Then we have CPI, we've got the Fed meeting, and we've got options expiration all in the same week. So, and then the holiday right in the middle of it. And then it could continue to sell off. We'll hit the low of the month way down here before we get 3 weeks, a 3-week rally. All right, so that's what the history looks like. So let's go back over here and take a look at the dashboard. So the dashboard, all of the equities did well today. There's the Dow, S&P 500 went up and then sideways. NASDAQ 100, same thing. The VIX, it's not showing the VIX, but I can click on it and see the VIX. So the VIX actually went down today as well. Ended right down here at 1775, so not quite below 17 yet, but certainly in that neutral zone. And if we go down much more, if we get that rally for the rest of the week, this will probably be down here below 17. And that is bullish as well, if that happens. So that's positive for the VIX. Interestingly, the sectors are mixed. Say technology and energy and materials are the 3 top ones. Technology is definitely the most aggressive sector. But the defensive ones has also communication services, staples, and real estate. So that's a mixture of aggressive and defensive. Not quite sure what to make of it other than communication services is where Google is. And I'll show you in a minute, Google was the only one of the Magnificent Seven that had a bearish early signal today. Advancers and decliners were all positive. Here is CrowdStrike reported after the close. Dollar General reported before the close. You can see they were up nicely. Before the open, they were up nicely. CrowdStrike, we don't know yet. I'm going to look at that in a minute. HPE, I think, was after the close as well. And then Campbell Soup was yesterday and didn't really do too much. But let's look at these 3. Let's look at let's look at these 3: CrowdStrike, Data General, and HPE. So there's Data General. You can see a really nice day. They reported before the open, so clearly they had pretty good numbers. If we look at this again, you can see CrowdStrike right here is minus 460%, so that's probably not going to look too good. Data General up 20%. This is earnings versus estimated. So estimated was $1.49. The earnings came in at $1.78. Over here, estimated was minus 7 cents, came in at minus 37 cents for CrowdStrike. So let's take a look at CrowdStrike over here as well. CrowdStrike right here down 6% after hours, almost $30 down. So down to about 460, which would put it right about down here, right about there. After hours, and probably will continue lower. Likely is going to head back to the 21. That could be a buying opportunity when it gets down there. So we'll keep an eye on that. And then the last one was HPE. HPE is up after hours 3.5%, 1830. So it was sitting right on the 21, reversion to the mean. You can see here I got almost up to the 3x area, revert to the mean, to the 21. And started to move up before earnings, and earnings were after the close, so it will likely go higher. So it ended at 1769, and after the close is at 1830. So looks like HPE will continue to go up. All right, that's it for that section. Let's look down here, and you can see Renewable energy, I talked about this in the midday update. This was the one industry group that hit the scan, the daily scan. So, and now it's at the top of all industry groups at the end of the day today. There's Data General right there. Summit starting to make a move back higher. Uranium had been doing really well, pulled back, and now it's starting to move up again. All right, what else do we have over here? Semiconductors is on here. Heavy construction, coal, kind of a mixture of sectors. There's technology, industrials, materials, discretionary, energy, industrials, technology, discretionary, energy. So a mixture over here, but let's take a look at renewables. So when you see something like this on the dashboard, you can go over to the website, to the charts page, and you can go down to the industry groups. Renewable energy is in the technology group, and this little box right here will show you the stocks that did well today. This is just today. Sunrun up 16%, fuel cell up 14%. Canadian Solar, Array Technologies up 6.5%. First Solar up 6.5%. Solar Edge, so it looks like solar is doing really well. Enphase up almost 6%. So those are the one. Next Tracker up almost 5% just for today. Go back a week, and we'll see this one here. I don't know anything about this. Never heard of that stock. Sunrun up 15% for the week. Enphase up 8%. Solar Edge up 5% for the week. NXT up 3.75. So you can see that that was the number one industry group, and it looks like it's doing really well today. All right, so that's it for that section. Let me go now and take a look at a couple of the stocks that people wanted me to look at. One is MDB. They report tomorrow, I believe. Yep, tomorrow after the close. So MDB kind of going sideways, sitting right in this pocket right here. So waiting for earnings, it looks like. Let's see, it's in the software group, which actually has been one of the top sectors or top industry groups. Let me go up and actually look at it this way. MDB. So MDB right here. Yeah, I need to do a different one. It still has my expected move from the Russell 2000 on there. Do a fresh one. All right, MDB, and the one thing I want to look at is how are they doing versus their industry group, which is software. How do they do versus their peers? They are underperforming their peers, and they have been since March, really since February. So ever since the market started going down, they followed the market down. They are outperforming the S&P, which is good. So kind of a mixed story there. The accumulation distribution line is starting to move higher, but it has not broken out from the high or this high back here. So it doesn't look like serious accumulation. A little bit's going on. Up here is the RSI starting to pull back a little bit, and money flow is the pink one. The RSI is the gray one. So it's sitting right above the halfway point, and money flow is starting to pull back. So I might be a little bit concerned about MDB. Can't really tell too much right now from the chart because it's sort of sitting right in this sideways pattern. Now for consolidation theory, that means when it moves up and consolidates, the target, so down here was 150 and the consolidation is at about 190. So theoretically, it could go to 230 right up here in consolidation theory. So we'll see if they have good numbers, then it could get up here to 230. But they're underperforming their peer group, which I never like to see. Let's look at it on a weekly basis. Does not look good, again, from February all the way down. And on a monthly, again, monthly, they IPO'd right here. It's got two lower highs. And then from this high, it's got another lower high. So it looks like it is putting in lower highs. It looks like down here is pretty solid support though. So it's trying to recover from that. So it's going to, that report tomorrow will be really important for MDB. Another one is CEG. This is interesting. I showed you uranium previously. This is a monthly chart, Constellation Energy, just been going straight up. And what's happening right now with uranium and nuclear is that a lot of the big tech stocks are making investments in nuclear reactors to get the power that they need for AI. So that's an interesting play. It's almost kind of a play on AI too. So on the weekly, it came right up here. Looks like it's putting in a double top. It pulled back today. In fact, that is a shooting star. So that might be a failed breakout. Didn't quite break out, but got right up there near the high. So that really needs to move higher. Let's see, the next earnings is until August. And you can see right here, came right up almost exactly to that. Let me put a horizontal line, make it blue. Right there was the top. So all these people over here that bought and then saw it decline significantly, they all want to break even. So when it got up here today, it opened up here and sold off all day long. It's not even a black candle. A black candle means it did not go lower than the previous day's close. But in this case, it did go lower, so it's red. So it looks to me like that is putting in a double top and may continue, and big, huge volume today too. So may continue to fall from there. All these people over here want to get out at break even. These folks were hoping it would get above there, but with the big sell-off with huge volume, I almost guarantee you that all of these people over here are part of the sell-off right here. So I would expect that to continue going lower tomorrow. So I don't know what the reasoning behind the question, whether if you're already in it, I think it's probably going to go lower. Hopefully you have a profit. If you are thinking about getting in it, you might have a better chance a little bit lower down, maybe at the 21 day, if that'll hold. Let's put one more line in here, right here, this support level. So there's the other support level, which is right at the 21. So that right there should be pretty solid support if it gets down there to about 285. End of the day at 313. All right, so that's CEG. And next one is MU. Micron, we've talked about this before. Micron breaking out of this consolidation, so that's positive. But let me show you. Let me put a couple of lines in here. Let me first put one in right about here. So there's resistance there. 1, 2, 3 times. Let me put one in right here, where it came down and tried to come back again. Actually, what I'm gonna do instead is put in a trend line. That would be even better. Trend line right across those right there. So from that perspective, it is definitely breaking out. So it will still need to get above these. So all of these, just like I said before, these are all people that want to get out at break even. So it's going to have a lot of work to do, but it may be headed back up here to 110 in that area. And then we'll see if it reverses from there as we go into the after this week. The next couple of weeks in June is usually bearish. So we'll see what happens with this, but it looks like it's definitely breaking out, broke out of the consolidation. Consolidation theory says that it should go from about, let's call it 65 to this consolidation of 95. So 30 points. So 125 should actually break out of this one too, make it up here to about 125. So we'll see. Interesting one though. Semiconductors, remember, was on the top 10 list for industry groups. Right, the last one is Berkshire Hathaway. And the comment, person that sent me this one, the comment was, should this be treated like an index because it's a consortium of companies, basically, that make up Berkshire Hathaway. And that's true of a lot of big, huge companies, by the way. It's not just Berkshire. There's lots of companies like Procter and Gamble, for instance. Lots of companies that are made up of other smaller companies. So it should be looked at like one of those. But another way you could look at it, and the question was, should it be a stock or should it be an index? I would not call it an index. It certainly is a stock because you can buy it just like a stock, but I would compare it more to an ETF. An ETF is a combination of other stocks, which are companies, basically. So I would look at it more similar to an ETF, but you buy it just like a stock. So first, let's put in the high right here because that looks like a double top. It tried to break out and then failed the next day. Not sure if that might have been earnings or not right there, but failed the next day, continued to go down, went below this support level, actually sitting right on it. It went below it today and then came back up and closed right on that support level. And then there's another key support level down here, right at the 200-day moving average at 480. So that the 200-day is really important. Where it is right now is really important. If it continues to go lower, which it looks like it may, right now these up here are price performance and the technical ranking lines. So this is how it compared to the S&P. It is still outperforming, but there's the zero lines heading. It's getting weaker, and then the technical ranking is coming in at 43, which is very low. It's in the lower half of all stocks in its group, in its segment. So, which is a large cap. So it's in the lower half of all large caps. So in general, it's going through some challenging times right now. It's trying to make a recovery, but everything is continuing to head lower. Let's look at it a little bit closer. That is a daily view. Let's go out and look at it on a weekly. So it's sitting right at the 21. So this 50 is really important. The 50 is at 472. So just like I said before, with the 200, that's going to be important right around that 480 level. And on a monthly view, this is just noise for Berkshire Hathaway from a monthly perspective. Keeps coming down here to the 21 week, and it is not there yet. So that is around 450. So between 450 and 480, it could easily come back to. Now, one of the questions was, this is a big part of this person's portfolio. What percentage should it be in a portfolio? And that is a personal preference. I cannot give you, I can't tell you what your level should be. If it is a large component of your portfolio, then it's much bigger risk, of course. It depends on what your risk profile is. I'll show you something when I look at the risk calculator that will help you with that. But if you want to have 10% of your 10% of your portfolio, each stock be 10% of your portfolio, that's 10 stocks. So if it's more than 10%, then you could trim it back to get to that 10%. And that's the way you should look at it, especially when it starts to decline like this. So when it closes below this big bar right here, this red bar, when it got below the 21, and then this is the daily chart, and then couldn't get back above it, that would be the time to trim back to that 10% level. So that's one way you could do it if 10% is your number, and I don't know what your number might be, but 10% means that you would hold 10 stocks in your portfolio. If you want 20 stocks, then that would be 5%. Should only be 5% of your portfolio. So it just depends. And you can vary that. You could have one stock be 20% and the other stocks be much lower, 5% each. Just it depends on how you want to do it. So 5% of 80% would be about 16 stocks, and one of them would be, and one of your 20 would be, one of your 16 would be Berkshire Hathaway. So that's one way you could do it. This will make more sense when I show you the risk calculator as well. All right, so before I do the daily scan, let me talk about how to use covered calls for how to use technical analysis for covered calls. So what are covered calls? First of all, this is Investopedia, which is a great site to learn about things. Covered call is a sale of call options by a seller who owns shares in the underlying asset. That's what makes it covered, owning the shares. Therefore, you could deliver them if the options are exercised by the buyer. I'll explain that more in a second. Key takeaways. An investor who sells a covered call sells, keep that in mind, expects only a minor increase or decrease in the underlying stock price for the life of the option. So it's best to use these with stocks that are fairly static. You do not want to use them with stocks that are very volatile because you could get called away very easily. Investor wants to hold on to the underlying stock, but does not expect an appreciable price increase in the near term. The purpose is to earn money in options premium, creating a revenue stream for the stock. So it's a way to create income from a stock that you already own without having to actually sell the stock if you do it correctly. And selling the option is much like being an insurance company, where an insurance company collects a premium from you. If your house does not burn down, then they keep the premium. And the next year they charge you again and you pay another premium. And if your house doesn't burn down, they keep the premium. That's what selling an option is all about. Very similar to that. So in this case, you're selling a call, making the premium. You're being the insurance company now, so you collect the revenue or the income. And as long as your stock does not go above the price that you sold that option at, then you keep the stock too, so your house doesn't burn down. So that's the idea of a covered call. It's an option strategy which the seller sells the call option and hopes to continue to own the underlying asset. Pros and cons. Covered options limit the risks and potential downsides of an options contract. That's true. In fact, covered calls at one time were the only option strategy allowed in IRAs. There's more now allowed. But at one time, covered calls was the only one that was allowed because it's pretty safe. Options writers, meaning the seller, can earn a reliable premium from a small price increase. The cons, options writers must be able to produce 100 shares for each call option. So you have to own at least 100 shares in order to sell a call. And an investor is very bullish on a security, they can make more money from uncovered calls or buying the underlying security. Covered calls means you already own the underlying security. But if, like I said, if it's volatile and you think it's going to go up a lot, then you actually could make more money just owning the stock. But this is a way to use covered calls to generate income for stocks that might not really be that volatile. All right. So that's what covered calls are. Let's take a look at an example, and I'll show you how to use. Well, first, let's go back to the website and go to the options page. And on the options page, right here, it explains the difference between being a buyer and a seller. So if you are a seller of a call, it's a bearish strategy, meaning you're hoping the stock will go down or at least stay where it is. If you are a buyer of a call, it is a bullish strategy, right? So in this case, you have the obligation to deliver the shares if it goes above your strike price. So you have 100 shares of a stock, you sell a covered call at a certain price. If it goes above that price, then you will then have to deliver the shares. However, you'll be selling them at a higher price, higher than what you're already at. All right, so as a seller, you always want to be on this short end of the curve. This is the time decay curve. So as a seller of an option, you want time to be decaying as quickly as possible so that you can keep that premium. As a buyer, so this green line here, these two are buyers. You want to be back here on this end of the curve, 90 to 120 days or more, because the time decay is very small in the beginning until you get to about 30 days and then it accelerates. So as a buyer, you want to have more time. As a seller, you want to have less time. In this case, we would be a seller of a call, so we want to have a short period. All right, let's go back here and take a look at, let me use Boeing in this case. So Boeing has now been going up pretty nicely, but it was in this channel right over here for a while. So how do you use technical analysis to sell a covered call? So remember, if it goes above your strike price, then you will get called away. You will no longer own that stock. You will have to deliver it to the person that bought the options. So what that means is you want to be selling your call near the top of the rally, the top of the rally, not the bottom. If you sell a call down here, you almost assuredly will be called away. So you want to do it when it gets near the top. Now, how do you know it's near the top? Well, a couple of ways that you can use technical analysis for that. Using the MACD up here, you can see where the lines cross, that end where it went below zero. So anytime the histogram goes below zero, that is confirming a downtrend. So as soon as it goes below that zero line right here, which happened to be the same place where this crossed, that's where you want to sell a covered call. So right here, you would sell a covered call when the price is at 177, and you want to sell the call higher. So the highest that it was before is 182. So you want to sell a call probably about 185, right up in here. Even higher would be better, but let's say 185. And you want to sell it for, let's say, 1 month later. So we're right here. The date is December 31st. So let's go over here to January 30th. And remember, you sold the call for 185. January 31st, right here, it closed at 176. See in that little box, the close right there, 176. So you would keep your stock and you would keep the premium for selling that call. All right, so then we want to do another one. The next month, we want to do another one, but you don't necessarily do it right away. Remember, watch the MACD up here. You want the histogram to go below zero, and you want the line to cross, both of those things. So that happened right here. And again, you want to sell the call for a little higher. So in this case, we'll probably sell it for 190. You see where the high right here is 188. So we can sell this call for about 190 1 month later. So right here is where it went below. So the price is at 180. We're selling the call for 190. And 1 month later, this was what? This was February 20th. So let's go over to March 20th right here. And it closed at 172. So you keep the premium and you keep the stock. Now, again, you don't want to do another one just yet. You want to wait for the MACD to be at the top, wait for it starting to decline. And in this particular case, everything crossed right when there was a big downtrend. So now you have to make a decision. Do I want to sell the call here? You could have actually sold it back here when it closed below the 21 right here, even though these hadn't crossed. So you want to use everything in your toolbox. You can see where the ADX line went. The red went above the green right there on March 31st, same day that it closed below the 21. So you could do it right there. In this case, it closed at 170 and the high back here was at about 185. So you could sell it for 185 and the date is March 31st. So let's go over here to April 30th and the close is 183. So it's below the 185. So you would keep the premium. So 3 times now you've kept the premium and you still own the stock. And now you own it through this big run right here. So you don't want to be selling covered calls as it's going higher. And you can just look at all the momentum indicators and everything else. Right up here, it started to go down right there. You potentially could have sold one, but I wouldn't have because the ADX, the green is so far above the red, it may just be pausing right here. And it hasn't come below the 21 either. So I probably would just wait for an opportunity when everything starts to roll over again to sell your next call. So that's the way you do it. That's the way you use technical analysis to do covered calls. By the way, I'll show you at the end what it would look like. There's a way you can do it without even having a subscription to stock charts, or whatever platform you use, you actually can use for that same idea. MACD is on just about every platform. All right, let's go over here real quick and look at the daily scan. I'll do the options one first. All of these have, this is the bullish, all of these have weekly options. So Apple making a comeback now. See Apple right at the 21. So Apple looks like it's starting to improve, starting to come up. That might be a good one. There's Data General, Dollar General rather. We talked about that before. Eli Lilly pulled back. It went above the 21, but pulled back. So it looks like it wants to make a run right here. Just a little indecision. So I would probably wait one more day for confirmation on that one. You always want to look at the earnings. Next earnings is in August. Medtronic was on our list this morning. Really nice move. Continued its move. This is the one that I showed. One of the ones that I showed at the midday update around lunchtime, and it's continued since then. Moderna was another one that I showed. It continued, but then pulled back near the end of the day. But that one still looks pretty good. On semiconductor, actually went above the 21 yesterday, so this is a little too extended right now for me. I probably wouldn't get into this one at this point, but yesterday it also made the list when it went above the 21 right there. Penn National, so gambling looks like it might be moving. Here's natural gas. And here is Upstart, Upstart is one that I added to our list, our daily scan list. So a couple of things I'll show you on this. Upstart actually made the list yesterday as well. Had a really nice candle today. The momentum is moving up. The green line has crossed the red line. Momentum here is moving higher. The MACD has just crossed over zero. And all of the moving averages look good other than the 200. So the 200 up here still needs to get through that one. So let me show you the daily scan of what it looks like right now. So there we go. There's our three: Walmart, Verizon we added previously, and Upstart is on there as well now. So 50.50 was the price that we bought it at, right near the end of the day today. So if we look at this one, you can see it actually ended almost at 51. So it's up 50 cents already. So again, there you can see it's being rejected here at the 200 day. So we got to be careful when it gets there, which is right at 55. So $5 is about 10% move. If that happens in a couple of days, that would be pretty nice. I might just take the profits right then because of that 200 sitting there, but we'll see. Let's go back and take a look at, and this green line down here is where the stop is. You can see where the stop is on this. Let's look at the other ones. Verizon, stop is down here. We actually had it lower than that, so we've moved the stop up now a little bit. And this is where we bought, so we're a little underwater, but not by much. So we'll keep an eye on that one. And Walmart, right here. Walmart is above our buy price, and move the stop up on this as well, up to 95. So that helps. Hope the goal is to move it up to break even at some point, or take a nice profit. So right now we're 99, about $100 right now. So we'll see. Let's also take a look at the diagonal spreads that I showed you before. So here's AI. AI right now, we took profits twice on this. No, I'm sorry, we took profits once. So we have 385 in profit, and this one will have another 385 if we let it go until Friday. But this was at $28 with the strike price. So keep that in mind. CELH, we've taken profits twice on this one. And right now, I did not do another one yet because I'm waiting to see what it's going to do. It could pull back a little bit, but right now we're only $250 away from breaking even. So we will have paid off our insurance. So the idea on this is to buy a put a long way out. So this is all the way out to September, and then sell a put in very short term, 1 week out. And when you sell the put, you keep the premium. So you can see here the premium we made on this was 85 cents. We sold it for 73. We made 86% profit in less than 3 days. This one here, the premium was 71 cents. We did it on 5/30 last Friday, and we bought that one back today for 15 cents. So that was a 79% profit in just 2 days, basically. Did not do another one yet, but you can see right now only $250 in each of these. If we do one more of these, then we will have paid off our put option up here. So we basically will have this put for free. That's our insurance. If the stock starts going down, we'll actually start making money on that one. So that's that one. Walmart was the other one. We've only got one on Walmart, but right now this is for Friday as well. Strike price is 97. So let's go look at a couple of these. There's Walmart. So strike price is 97 for that one down here. I think that's right at the 21. I think it's probably likely it's going to stay above that. So we will keep that premium, just like the insurance company. AI is an interesting one because we had a big run here on that first one and made money on that premium, then did it again. I should have waited a little bit on this. I should have known that that candle, it's a shooting star and probably would pull back, which it did. Sitting right here, started to make a comeback today. So remember the 28 was the level on this. Right now it's at 25.67. And the low for the day was 24.70. So it came up about $1 today. If it comes up $1 the next 2 days, two more dollars gets us close to that 28. If it ends on Friday above 28, then we keep the premium. If it ends on Friday around close to that, like 27.50, it likely will still be a positive premium, just not as big of a percentage. So we'll see. But if it doesn't, then I will own this stock as of Saturday morning, minus about $1.50. So 28 minus $1.50 in premiums, that's 26.50. So it only needs to get above 26.50 and I'll be breaking even. So that's the status on those. The last thing I want to show is, let's see. Oh yeah, I was showing this. Upstart I've already showed. We just added that to the daily scan. So let's see what other scans we have over here. There was one in Magnificent Seven, I believe. Yeah, Apple. I talked about that before. Arista Networks actually showed up yesterday. So this one showed up right at the end of the day yesterday. So we had a hammer after earnings, confirmation the next day, and it continues to go higher. This is a little bit more extended than I would like. I'd love to get it right here. I should have got it on this one yesterday. Eli Lilly is also on the list. So this, again, pulled back a little bit right at the end of the day today, but it is on the daily scan list over here. So those look like good ones. IBD, I think had one. Nope, nothing on IBD. Let's look at the bears. Boston Scientific. Starting to move lower. Right there, it has a squeeze going right now, so it looks like the squeeze is firing to the downside. So Boston Scientific might be a good short. What other ones? Mag 7, any bears? I think Google was on this one. Nope. I'm going to look at Google though. And then IBD, bears, Grinder. This is the IBD 50 list. Stride, which IBD actually had this on their list. They actually were buying it last week because of what this looked like. But today had a big, huge sell-off. I'm not sure what happened. It was not earnings, so I'm not sure what happened with this today. But huge sell-off, and IBD actually got out of it completely. And notice that it's got a squeeze going. So this squeeze looks like it's firing to the downside. And TradeWeb is the last one. Also, big red candle below the 21 and has a squeeze. So that's firing to the downside as well. So those are the short candidates if you want to play it that way. That's it for tonight. Thanks for watching. I will do an aftermarket on Tuesdays and Fridays. If there's something that's of interest during the week, I may do another one, but I'm not committing to it. But I will try to commit to Tuesdays for Technical Tuesdays and Fridays. So I hope that was useful. I have a playlist for Technical Tuesday, so you can go back and watch all the previous ones if you want to learn more about technical analysis. And please like and subscribe and tell all your friends about this, and I will continue to do it. All right, that's it for today. Thanks for watching, and we'll see what happens tomorrow. Take care.